Welcome to Making More Money for You with Magnus Carter. Whether you feel that you don't have enough money to start investing or are under the preconceived notion that investing is only for the wealthy, Magnus and his expert guests are here to help you. Now here is your host, Magnus Carter.
Hi, everybody. Welcome to the show. I am your host, Magnus Carter. We are on the Making More Money for You show on Voice America Business Channel. I want to give a quick shout out to my guest last week, Eric Smolinski from that's an ex-Marine that actually turned his whole life around from going from a bad situation growing up to the military to investing. And it can happen out there, and the people that listen to it, I thank you. I got the numbers. That's like actually one of my fastest growing shows. Thank you for tuning in. And well, that show leads us to actually, we touched a little bit on last week. Eric was also a small into real estate as well, but he was into the single house dwelling units, single home, single family dwelling. But today I have a very great show for you today with Kawaoka from simplepassivecashflow.com. Welcome to the show, Lane.
Hey, thanks for having me, Magnus. Aloha,
Oh,
everybody.
yes, excellent. The reason why, I've done a couple shows in the past. First show about investing in real estate or kind of in real estate was actually turning unused rooms into bed and breakfast, Airbnbs. That gained a lot of great traction, and I touched a little bit here and there on real estate because it's such a vast and such a specialized topic. What you invest in is way different than what Eric and a lot of my other guests invest in. So what made you actually go towards dwelling unit or multi units? I guess they would be called.
Yeah. So, I mean, the clients that we work with, and myself included, I used to be an engineer working a day job. Most of us, we have money to invest. We're short on time. So we certainly don't want to flip houses or do things that are more active because a lot of the folks I work with are like doctors or dentists or engineers. Their highest and best use is at their day jobs, or maybe for some of the business owners that are listening today, right? You guys have successful businesses.
Right.
You don't want to create another job for yourself, which is what flipping houses is and what short-term rentals are. But how do you invest in real estate for capital growth as much as the tax benefits? And that's maybe what we'll kind of get into today is, why do the wealthy have real estate? Well, it's something everybody can do, and it's kind of easy, and it can be done in a passive standpoint, but it's really the taxes. It's really the big play here.
Okay. We can definitely cover those because I know we don't like paying Uncle Sam our hard-earned money. We would actually like to keep as much as we can and grow our wealth. And you brought up an excellent point by doing that. But before we get into these topics and going into further in the show, I misspoke a couple minutes before, but tell us about yourself. How did you get from I see you went to college and whatnot. How did you get from college and working for a corporation to actually investing and owning a very profitable training seminar and simple passive cash flow as a company?
Yeah, so I mean, today we own a $1.2 billion of assets under ownership, and I think that's like 8,500 rental units. But
Wow.
I kind of was just brought up on this linear path of go to school, study hard, become an engineer, work for the man, do your 401k, and retail investments like that. I bought my house to live in just with the normal 20% down payment in my early 20s, and then because I was a construction engineer working on the road all the time, I was never home. So I just decided to rent it out. And that was way back in 2009. And that was really where I got this taste of cash flow. And I realized, man, I was making a lot more money, with the tenant paying down my mortgage, the cash flow, the tax benefits, and the appreciation than I would ever dream to get in this so-called 401k normal stuff. And if I was making like 3, 4, 5 times as much in that stuff. And if people want to watch like a video where I kind of break down how much do real estate investors, passive real estate investors, really make in terms of returns, they can go to simplepassivecashflow.com/returns. But at that point, I realized, yeah, I just need to rinse, wash, repeat, and buy more rental properties. And that's kind of what I did for the next decade or so.
Okay. Now, when you were looking at the rental properties, did you stay close to where your first property was, or were you doing it as you were actually working because you were still working for that company at the time still? Am I right?
Yeah. So very different, right? And I think I said it at the top, right?
Hmm.
Most people think of real estate investing as flipping houses or
Right.
wholesaling. That's not what I do, or, especially for kind of our profile of people we work with, right? Our time is more valuable than our money. So it's just a matter of, when you're starting out, you're saving the 20% down payment and going after good solid assets. So, I was buying properties where I lived when I was in Seattle, bought a few units there, but then I realized that sophisticated investors invest in, lesser known areas or secondary markets where you have this thing called the rent to value ratio higher than 1%. So, it's pretty simple math, right? A lot of you guys can do this at home right now as you're listening, but you take the monthly rental price divided by the purchase price, and you're looking for something 1% or higher so that you're going to cash flow on a positive basis. So, you take a property out in, California, that's $400,000, and it's probably in a rough area you'll want to invest in, but that's, you're probably going to rent for a couple grand. So $2,000 divided by $400,000 is 0.5%. That's less than the 1% ratio. Then it's not going to work. What we kind of focus on is like, places that make $1,000 a month in rent divided by $100,000 purchase price. That's the 1%. That's a quick and dirty way of vetting the numbers really quickly. People want to go down to our website and download our free analyzer. They can kind of get into the nitty gritty, but for our purposes today, the rent to value ratio is kind of what we look at first, because we want to go into assets that cash flow just in case there's a recession, we hold and, cash flow and chill after that.
Well, yeah, you brought up a great point. Is recession. A lot of people, these current times are not the best at putting it very mildly, of actually investing in something like this. So how do you leverage your assets to actually help you invest and continue your investing and build?
Yeah. So the people who got hurt in 2008 were the boneheads investing in appreciation and gambling that the prices were going up, which is very different than what we do. I mean, that's why we call it simple passive cash flow for a reason, right? It's cash flow first.
Hmm.
So we want to be going into assets that, hit that 1% rent to value ratio, that produce positive revenue every single month, even after expenses, property management, because we don't do that. We outsource that garbage activity out, right? Because
Okay.
our highest and best use is making more money for the down payments to go buy more assets to expand our balance sheet and asset sheet there. But that's kind of the big thing is, go into fiscally positive investments so that if there is tough times, well, we just hold in cash flow. We don't necessarily need to sell.
Right.
And in fact, like whether the price goes up and down, we don't really care, right? Because we always want to sell in the right time. But if we don't, we want to just hold in cash flow, and the property's not bleeding us money like it would in Seattle or California, those types of assets.
And to your point with that is you want to keep as many tenants as possible within those units as well. Am I correct? And you want to stay away from the places that actually the cost of living goes up astronomically, where they can't afford that and have to move out of the area.
Well, that can also help us out, right? Like
Right.
I think, more and more people, and that's why we focus on workforce housing. So the lower middle class. So
Mhm.
rents between $700 to $1,300 a month,
Okay.
right? These are the people that are on the lower middle class. They typically will not buy houses to live in. They just can't afford it, right? They
Mhm.
can't save up $20,000, $40,000 to save their life. And not saying it's right or wrong, it is what it is. And that population is going to be increasing, which is why the reliance and the need for like apartments for, nice little single family homes that rent for around $1,000 is going to be increasing. It's not a sexy way of investing. It's, it's not super glamorous, but as far as like the risk reward profile, I think as an investor, you can't beat it, right? I mean, it's just, there's an undersupply of houses, especially in this demographic. And, people need a place to live. And as a landlord or an investor in a syndication deal, taking down like a large apartment, I think it's all like, to me, it's like no brainers. I mean, you look at all kinds of businesses out in the world, it's you're backed by real estate, and it's in like it's just the fundamentals align. Like there is less supply than there is growing demand for this stuff.
Oh, you're right. More and more, everybody is either moving or they're becoming of age or getting out of college, and they need places to live. And what you're actually teaching is the people that invest in this are having cash flow that comes in, and the more units you have and the better condition they are and whatnot, the better your return is. Am I correct with that?
Yeah, and you just have
Okay.
to beat the people in your asset class, right? So like, I mean,
Okay.
we don't go after luxury apartments or luxury properties because that's just, I don't feel like you get the return on investment for that stuff. It may appreciate better, but again, we're more cash flow oriented investors, more value investors. And, we focus in on these types of properties where if there was a recession,
Mhm.
we play these kind of war games in our head, the A-class tenants will move down to the Bs and Cs where we are. So our business demand goes up as times get difficult, if that ever happens.
If
Hopefully it
that,
doesn't. But if it does, you want to, this is where like short-term rentals, short-term rentals are all discretionary spending. It just dives off a map. And that's not what I want to base I want to go into an investment or a business essentially where right now things are good, but if things are bad, I can still stay in business.
Mhm. Right, right. Well, you brought up a great plan, some technical stuff here. Can we clarify what differentiates the classes of like A, B, and C classes? How do you determine what to invest in, how many to invest in a certain demographic, or we expand on that, please?
Yeah, great question. So like the way we kind of grade these properties is, the asset class and then the tenant profile. So two different things. Tenant profile is kind of like the neighborhood and location.
Okay.
The neighborhood location is probably more important, right? So you have A class areas, B class areas, C class areas. So A class areas are all your yuppie, your cool places to be, right? Coffee shops, people walking their dogs, you're not going to find properties that will produce positive cash flow in these places. It's just too expensive. Your rent to value ratios are going to be out of whack there.
Okay.
So what we're trying to look for is there's a nice little sweet spot in the high C's and the low B's. Now, these places are categorized as, and this is all a feel thing, right? There's no like hard and fast rule on it. But if you walk to a certain submarket, you kind of know what it is. But essentially what we look for is, a place that maybe I wouldn't want to be there in the nighttime, but in the daytime, it's all right. It's relatively safe. It's not going to be where the best schools are, because that's where the A-class locations are that don't make, financial sense. But it's certainly not where the war zones are. There's not really violent crime there. There's some theft, there's some graffiti there, of course, but it's kind of in that middle rung. And then moving over to the asset class side, like A class is more your 2010s built later, your newer properties. Your class Bs are more your 1990s to your 2010s. And then your class Cs are anywhere from like 1950s, up to the 90s, right?
Okay.
You can have, it's not a bad strategy to buy any of those types of properties in those B type of areas. Typically, we try and buy the B and C properties in the better location because I can't really do too much with the location, but we can force appreciate the assets in wherever it's at. And that's pretty much our simple business plan. We take over an apartment in a, B or better area, typically an A area, but it might be an old beat up 1950s, 1960s, 1970s property. but we might throw in $5,000 to $10,000 of rehab into every unit. So new flooring, new paint job, new appliances to spruce it up a little bit. Nothing
Okay.
huge, right? We're not banging down walls or taking down cabinets or anything like that. and and again, like it's not like none of the stuff you see on like HGTV. Like that's just too much rehab. That's over rehab.
Yeah, that's
Like
a
we're
lot.
just trying to bump the rents up, couple $100 across the board. As we cash flow, all the other 95% of the units are being tenanted and producing cash flow for us.
Okay. All right. That makes a lot of sense because I notice, I don't know how much you get out to the East Coast here where I'm actually at. I remember when Atlantic City got like that, all the casinos that went out, people bought the casinos up and did exactly what you were talking about. And they made those efficiency apartments on the boardwalk because who else does not want to live on the boardwalk? Which is, that's, and I see your point is, the more you want to have more income and more tenants coming in than like you're saying with the A class. You don't want the ups and downs and things happen and whatnot for a couple extra $1,000. You'd rather have the steady income.
Right. Like we
Okay.
want to, I mean, I truly believe that we position ourselves to have the best risk adjusted return. There's a lot of things in this world that you can invest in, like altcoins or, crazy businesses that you can make a whole lot of money. But as far as like, people Google the term the Sharpe ratio, or essentially, which is the risk adjusted return, right? What is the most return you can make for the least amount of risk? I think that is, just this workforce style housing where you spruce it up a bit, call it lipstick on a pig. I don't think like, if you play the war games of a recession coming tomorrow, I think you're doing all right. You get a tenant in there, you can screen the right tenant because you have a pretty good product, right? A good
Right.
quality value dwelling unit, and you could pick and choose from a quality tenant.
Okay. That makes the screening process is definitely part of it. Especially getting the right people in there because you don't want to get into legal battles for
Yeah.
whatever reason, and you want to have that pre-screening done, do your homework on it instead of multiple turnover rates.
Yeah. And that's, you kind of get into the operations a little bit. And that's where we advocate for our investors. Don't even deal with that stuff. Just outsource it out to a property management company. That's their sole job, is to operate and fill that thing with a good tenant. It's partially their problem too, right? If they pick
Right.
the bad person. So whether you're on the residential side or for us, the commercial side, the property managers, they're the best money we spend. So is our feeling.
Okay. Well, a lot of my listeners are looking at other ways to generate income. That's what the main focus of this is, making more money for you, the listener, and for people that are already investing. So to get into this type of real estate, what do you actually look for when you look at a building? Besides, well, we talked about location. What other factors determine whether it's a good fit or if it's one that should be bypassed?
Yeah, I mean, I think we'll start from the other side. Like, it's not really the particular building. I mean, it's at that point, it's more numbers, right? Is this thing going to
Okay.
hit my rent to value ratio? And a lot of that doesn't really matter what it looks like. And this is another reason why we like apartments, because it's essentially cookie cutter. It's just,
Okay.
the interior walls at the end of the day. Whereas single family homes are all different shapes. But even single family homes, it's just essentially square footage in bedrooms and baths.
Right.
For us, it's more macro factors, such as, like, we don't invest in primary markets like New York, San Francisco, Seattle, Hawaii, Miami, Boston, because you're just not going to have the rent to value ratios there for it to make sense. We'll focus more on these secondary markets like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, Huntsville, places in Texas. And then secondly, we focus on red states. Not to say anything politically, but when I'm the landlord or when you're the landlord, you want to have the landlord laws on your side.
Right.
When people don't pay, you can kick them out. Imagine that. And then, it's just numbers after that.
Okay. So it's all a numbers game. If you get the right number combination with the building that you found, if it goes, you can actually go do that and actually invest in it and then turn it around, like you were saying. Then start outsourcing people, because you're gonna
Yeah.
need like a little army of people that work that will actually make the rest of the investment work for you.
Yeah, and this isn't rocket science, right? Like, I mean, the supply demand, like even in this whole country, right? Like the population is increasing and the need for this lower income workforce style housing is certainly growing. That bottom half is growing. This is that's where we try and look for places that we call emerging markets, right? Places that are increasing in population. And a lot of this is very readable information out there. You try and buy on in the states and cities that are increasing in population, and then, you know, less more important than like what does the building look like. It's more like what submarket or what block to block are you in? Is that kind of an area where up and coming jobs or just generally population growth, is kind of the driving factor. Um, after that, just get a property manager and you're off and rolling. Or you just, if you're already a successful business owner, and you're an accredited investor, just, find, reputable syndication operators and jump in as a passive investor in a large apartment complex investment.
Okay, with doing that is you just can you walk us through actually going through that process as another alternative instead of going through everything of the calculations, or would that be also splitting profits and what you were talking about
Yeah,
right there?
yeah, exactly. So like, like I think for most people who are not accredited yet, to buy rental properties makes a lot of sense because you don't have that much money.
Mhm.
But for a lot of accredited investors, and accredited investors are, people who make over 250,000 a year, or they have a net worth of $1 million. Buying little dinky rentals isn't going to really move the needle for you. In fact, after a certain point, it's going to create a lot of headache for you. In 2015, I had 11 of these rental properties, and yeah, I had a professional property manager doing all my dirty work for me, but it got to be, 10, 11 rentals at a few $100s, like positive cash flow a month is $3,000 a month. I mean, it's great, but
That's
need more, right? You're going to
right.
need a lot more than that. And, like for just to give some people some insights on those 11 rentals, I had maybe an eviction or two every year. Some kind of big issue that happened every quarter, like a tree fall on the house or like some kind of minor flood out in the basement or something like that. No problem, because the property manager takes care of it, and you just have to kind of bird dog them that it gets done. It's not a big deal, but if you increase that frequency rate by 3 times, if you had like a 30 units in your portfolio, then it just becomes kind of a second job in a way.
Right.
And this is where like I kind of went on a personal discovery, and I joined different mastermind groups and got around other higher net worth investors. And a lot of them were ditching their little rental properties to be a passive investor in a syndication that would buy a large apartment complex. And all this is through SEC documents, 506C offerings, where you jump in as a passive investor. No different than like a joint venture, but
Okay.
there might be 50, 200 investors all putting in 50, 100 grand into the pot of 10 million to go buy a 300 unit apartment complex. Some people call this private equity, right? Is another word for this. But the way that I explain this, it's kind of like an airplane. Like an airplane, you have the cockpit filled with the general partners, the sponsors of the deal. These are the guys who do everything. They find the deal, they use their connections, they put the debt in their own personal name, and they fly the airplane. And all the past investors come in, coach, and they go to sleep. that's
Okay.
that's their and they collect their split of the profits as they have equity ownership share.
Oh, all right. Well, that's just hand them a check and watch the money come in.
Yeah, sit down, be quiet, and watch a movie, go to sleep, and cash your checks. But this allows investors to jump into dozens of different individual projects, right? To get the
Right.
diversification on their end. And I think the biggest thing is as I've kind of realized, like, you got to get off of the retail investment path, because the retail investments to the big brokerage firms or Wall Street or your financial planner are all just kind of retail garbage, with a whole bunch of, middleman fees paid to everybody along the way. And this is very early on. I was like, why the heck am I making 8 to 10% supposedly in my 401k that goes up and down like a roller coaster? Yet I can make 25 to 30% in my little simple rental property that I didn't think that was that great of a deal when I bought it. I just bought it retail off the MLS. People can go look at, again, simplepassivecashflow.com/returns, check out that video. And then that, for me, very early on, was the aha moment. I was like, well, who's stealing all my money then if I'm only making 8 to 10% in this garbage?
Right.
And congratulations, everybody. You've uncovered the curtain behind that's covering Wizard of Oz. It's all a sham. They're all stealing all your investment money. If you guys just did it yourself or jumped more directly aligned with the sponsor or the person doing the deal, you cut out all these middlemen and you can take on a lot less risk and make much higher returns.
And
but it requires a little bit of effort on your part. Whereas most people out there just play on their computer all day long and just kind of blindly trade their 401ks and mutual funds and little stocks here or there.
Oh, you are right about that. Knowledge goes a long way, especially in this world. But Lane, already we're halfway through the show. We're gonna go back. We've actually talked about your path to investing, how you got into it, a couple different classes of investments. What makes a good investment, how to actually keep the cash flow coming in. So we're gonna take a break right now, and we're gonna come back and talk about taxes and a little bit more about you as an entrepreneur, and you're also an author, so I'd like to get into that a little bit as well. So guys, thank you for tuning in. I have Lane here with Simple Passive Cash Flow, and we're going to take a quick break and we'll be right back.
All clear. Great segment.
All right, thank you.
All right, 15 seconds.
Okay.
You are listening to Making More Money for You with Magnus Carter. If you have any questions for Magnus or his guests, join us on the show at 866-472-5789. That's 866-472-5789. Now back to the show. Here is Magnus Carter.
Welcome back, everybody. If you're just tuning in, thank you for joining us. I am your host, Magnus Carter. You are on the Making More Money for You show. I have my guest with me, Lane from Simple Passive Cash Flow. We talked about the introduction to actually investing in multi-home dwelling units. Welcome back, Lane. Thank you for being part of this.
Yeah, thanks for having me.
Oh, absolutely. It was a great conversation that we talked about in the first half of the shows. We went over the classifications of buildings, what makes buildings worth investing in, and how to actually make sure that your investing is positive instead of a negative return. You know, and which doing that is everybody does not want to pay the tax man. So how does owning real estate help you as an entrepreneur slash business person fight the well, not really fight the government, but keep more money in your pocket than Uncle Sam's?
Yeah, I mean, I'm not a CPA or tax attorney, right? So I'm gonna caveat everything you're gonna say in this next half. But I also don't pay too much taxes too, right? And sometimes the CPAs, they're not the best at tax strategy. They can do a tax form. That's why they went to school for that, right? But you never take financial advice from somebody who's not financially free or haven't figured it out themselves. And a lot of those CPAs, quite frankly, still have jobs that they work and they trade time for money. So take everything I say with a grain of salt. But the cool thing about real estate is it creates a tremendous amount of paper losses or passive losses. So like people who've owned rental properties before, they know that they can deduct the price of the property improvement over 27 years. So like my first property was like about $350,000. This is in Seattle, where the price of the land was pretty high because it's kind of the West Coast. But I was able to take about $6,000 of depreciation every year because the land improvement divided by 27 years, that came out to about $6,000 a year as a paper loss. I didn't lose money, but that money, that $6,000 paper loss, can be used to offset my gain in that property. So say I made $5,000 in profit that year, I could deduct this $6,000 and be negative 1,000, even though I certainly made money, right? But it effectively knocked out my gain. And that should be an aha moment for a lot of people. But wait, there's more, right? So like the cool thing that I discovered when I started investing in syndications as a passive investor is, because these assets are so much bigger, you can do what's called a cost segregation study. I mean, you can cost seg anything you want, but cost segregation studies do cost like $5,000 to $10,000. And, at that point, instead of waiting 27 years, you can a lot of times deduct 1/3 of the property value all in the first year. So this might augment your first year loss by maybe tenfold, maybe more. So what this does, it creates a huge paper loss, more than you're ever going to make your first several years in the investment, more than likely. So that's, now you're just knocking out the gains from that individual investment. But so here's, I think, where we lose some of the kind of the invest or the CPAs, right? Like what you can do is you can group all your investments that are considered passive income. And you can use these passive losses to knock out the passive income from all these investments. You can group this stuff. So like if you have other rental properties or you have other business where you're a passive investor on, you can use these losses to knock out these gains. Now, what you can't do is you can't use the losses to offset ordinary income, right? Passive losses offset passive income. But passive losses cannot offset ordinary income unless you implement you can check the box on your taxes that you are a real estate professional. Now, we're not going to get too much into the details today on how do you get this little box checked on your taxes, because there's a multitude of ways to do it. But some of the easy ways is, just getting a little short-term rental or just getting a little rental property, but you certainly can have a job. But, one use case is like, we'll have a lot of high, income earners, like a doctor or a successful business owner making $600,000 a year in ordinary income, right? Again, we can't use the passive losses to offset the ordinary income unless they qualify for rep status or real estate professional status. But in many cases, especially for a business owner or a doctor, they may have a spouse not having a job. So if we can create the situation where they are acting in a facet of real estate professional, Now what happens is they can use all these losses they're getting from their real estate activities as a passive investor, or, even rental properties, and lower their income. So ideally, we do this all the time, a doctor making $600,000 a year, if we can lower them down to $200,000, a delta of 200,000, 50 cents on the dollar is pretty much the tax difference right there. We just saved them 100 grand by just doing that. So it's a very powerful thing. And, it's kind of the knowledge of how to do this. And this is what kind of befuddles me. Like, supposedly like Joe Biden's going to be going after all the people that make over $400,000 in income. I'm like, well, all the real estate investors just kind of laugh at that, because, you should be able to just lower your income to whatever you want.
Right.
So you don't get hit by all those $400,000 activities. So it's very there's definitely a difference between high income earners or successful business owners and the wealthy people that know these types of strategies that are completely legal. And exactly to me, the way I see it is, it's not that you're dodging taxes. You're just following what the freaking IRS code is telling you to do.
Right.
They want you to invest in this type of stuff, especially like workforce housing, right? Like, we're not China. We don't have these government subsidized or these government projects. Like this is how they get the money into the system. I mean, they give us really sweet government Fannie Mae, Freddie Mac subsidized loans, so we can go buy a $50 million apartment, so we can house and give these lower middle class workforce housing good quality living conditions, because the government is not in that business.
Oh no, because the people that can't afford that and not working are not paying taxes. So they can't collect the money on their end of it, and it keeps you investing, keeping the money turning.
Yeah, and this is kind of our ideal client, is like the working middle class, the shrinking middle class, should I say, right? Like it's not the poor people paying the taxes.
No.
They get handouts. Although sometimes the lotteries are a way of taxing the poor, I would say, but we won't get into there.
Yeah, that's a different show.
It's not the wealthy people, right, who know how to use real estate to create a whole bunch of losses on their side and minimize their taxes. It's the middle class that suffers, right? The hardworking people that are blindly duped into going to these 401ks, and really these are the high producers of society that are getting killed the most with taxes and paying the bill for the highs and the low end people.
And then when the last couple years that everything shut down, that devastates everything except the housing, because everybody still needs housing.
Yeah. So this is kind of my passion behind simplepassivecashflow.com. I mean, it's, as somebody who was working in the cubicle as an engineer and did everything I was supposed to do, right? Study hard so I can be a high contributor to society, and then invest in my 401k. And yet I'm the one paying everybody's taxes and government subsidies. I just think it's wrong. But there's if you educate yourself, and which we do, on the podcasts and the YouTube channel, and, people want to just buy the book, there's a very, you start to learn that the wealthy do things very differently.
Yes,
but
they
it's
do.
something that the average person just can't start to implement. But it's just surrounded with a lot of noise and conflicting information that I think people can't wrap their heads around. Because as myself, like, I didn't have any accredited investors or friends or family or contacts that I could really ask, like, how do you really get wealthy, as opposed to just bang your head against the wall with all these other retail investment options and pay a lot of taxes in the meantime.
You brought up a lot of points here. So with you, doing so well, you offered to spread this knowledge in your book, and I believe your book is actually on Amazon, if I'm correct. Am I right on that? The journey to simple passive cash flow.
Yeah, it's
That's
very
your book?
simple, right? Invest in good deals where you trust people and you're closer to the action. You don't have all these middlemen. Secondly, use the passive losses from real estate investments, maybe implement rep status to pay less taxes. And then, do a little infinite banking too. That's kind of the last thing. But the combination of those three strategies often gets people to financial freedom 3 or 4 times as quickly than doing it the normal way, where you're kind of white knuckling your way and saving your way to, your retirement.
And sometimes retirement's not even an option for some people. And
Yeah.
that's horrible.
Yeah. If you're not saving $10,000 a month, I don't think you can ever retire. I mean, you're probably
No,
gonna
not
have
in
to keep
this market.
working forever.
Yeah.
Yeah. And that's the sad thing, right? It's definitely the rich get richer and the poor get poorer, right? Like most of my investors are able to save 25, 50 grand per year because they make a good salary. But until they start to put their money into the right investments that make more money than they are at their day jobs or trading time for money, they don't really start to accelerate. And that's essentially in this world, there's 2 kinds of people who trade time for money and people who, have money work harder for them where they don't have to do anything. And then there's a small portion of people in the middle that I think are kind of in our community.
Okay. It's very diverse out there because not everybody will grasp this, and not everybody will find this as their path, but just to try something out, just to get out of that 9 to 5 mentality, to move into a better life instead of waiting for the clock to hit 5 o'clock.
Yeah.
And you did make a valid point, earlier, is property management. So during your progression up to where you're at right now, is there a natural progression from starting out to where you are, or is it just moving around, doing the calculations and building it slowly, or is it just jump right in and go at it?
Well, I think if you're an accredited investor or you have $1 million net worth or greater, I think that there's an opportunity for you to kind of jump straight into the passive investor role.
Okay.
Sure, you still have to educate yourself and expand your network, but I think part of this is like the journey to financial independence, right? You have to get yourself unbroke first.
Okay.
Majority of the people in this world, I would say 90% or so, just don't make enough money and just spend more than they make. For those people, Dave Ramsey, Susie Orman, or a lot of these save your money type of financial blogs out there, I recommend those, but I'm not the person for that. The people
Okay.
I work with are kind of on this 1.0 scale where they say they're good with their money and they make good salaries. They save, 10 grand, 50 grand a year, and they need to get on the opposite, right? They need to get away from the Susie Orman, Dave Ramsey, pay off debt, and they need to go into deals with good debt service coverage ratios and have their money work for them, right? Stop paying down their debts and get on the offense by assets, essentially. Kind of the rich dad, poor dad mentality. But, like once you get going down that stage, and you hit that $1 million net worth threshold, you're not rich at that point. You've kind of unlocked another portal. And that's kind of where these, you've got to find other people along this path. But it's already at that point, I mean, you're probably talking the point, 1% or less, right, of people out there. Certainly your friends and family aren't going to be thinking the same way you are.
Oh, no, because we brought it up multiple times and on on multiple shows and in my books, and probably and most likely in your books. We're still taught to go to school. We go to college, get into debt, buy the house, find a job, and slowly progress up the job ladder slowly, and until you're like retired. It's like then you look back, it's like, well, what did I get done in my life instead of work all these hours and miss a lot? So I definitely agree with you on that. Well, your podcast, you brought up your podcast. What does your podcast cover, all these topics, or does it expand more into certain areas, or have you found that your audience requires something specific?
Yeah, I mean, my podcast, Passive Real Estate Investing via Simple Passive Cash, is kind of targeted to either you make a lot, you got a successful business, or you're kind of independently wealthy in your higher net worth, or at least you want to hear the higher net worth strategies.
Okay.
We are not an active real estate investor type of podcast. We teach what to look for in deals, how to network appropriately, the taxes, and then the legal, and then infinite banking. It's pretty simple, right? But it's very counterintuitive to what I think you'll find in other podcasts, kind of teaching you to trade time for money, being really active. Our assumption is that you're successful in your other business ventures already, or you're getting there, or you make a high salary at your W-2 day job.
Okay. I do have a question for you. I read on your profile, one of your profiles, who deemed you the anti-investment guru?
Well,
Or is
that's
that
the
your
thing, right?
mentality?
Like, there's a big, I don't know who did it, but like financial planners are seen as somebody who you get financial advice from. I don't know who the heck came up with that. I do know. It's all these like the border realtors, or like the investment complex that there is, right? Like, the whole system is engineered to get the average Joe's money into the coffers of these large institutions where they just fee you to death, right? I would say the majority of the money that is made goes to them in fees. How else do they have these large buildings?
Right.
So, and I think the younger generations, millennials, like, there's a big distrust in financial planners already. They're just like, well, just give me a freaking ETF and an index fund, and I'm probably going to outperform anybody, especially when you get like this schmuck that's just selling me these commission-laden products anyway. Still, we have the baby boomers that still have a lot of trust, or they just don't want to break up with their financial planner, who's probably a nice guy. But, again, you never take financial advice from somebody who's not financially free, and the financial planners typically are not it.
You're right. When I was being mentored, I always look for mentors, or what I want to go to, not where I'm at or where I've been. And that's, I was always taught that, especially from my mentors. It's like, okay, you hit this level and I can't teach you anymore. If you want to go further, look for somebody with, these qualities. Like your finances, not so much your cars or what you see on the outside, but how they treat you, and how they how their thought process. The thought
Right.
process is behind the scenes, because
Right.
anybody can have a Ferrari, or you can buy a Lamborghini, you can buy the house, the six-figure house and whatnot. But it's the people that actually take the time out of their day to actually give you time, which is the most valuable thing we have.
Yeah. Well, I mean, I the way I look at it is like, net worth don't lie.
That too.
Show me somebody who is effectively using these strategies, and that's the somebody I want to follow, right? But the stuff that I teach and the stuff we do in our community are definitely like, I don't want to say hush hush, but like, people just don't understand the stuff, and it's just not being taught, and it clashes with how the large financial institutions make their money. But it requires people to build relationships with other peers, other passive investors, to find opportunities to invest in, and especially find the people who to stay away from that are dangerous. And this is what I think is difficult about getting off the beaten path. When you're on the paved path investing in retail investments, it's consistent. It's consistently bad, of course, like how we mentioned. But, I guess what the nice thing is that, you're not going to be taken by a shyster, fly-by-night organization that just pops up and sells you a bunch of crappy rental properties, or, like a Bernie Madoff situation, which is why, we kind of, what I preach, or what's worked for me personally, is like, I build my network with my inner circle, and very quietly we invest with each other, and we get referrals from each other, and we figure out who to stay away from and who to invest with. And that is something that I think in this day and age, where people are so disconnected, and especially with the younger generations not having the people skills, it's getting harder and harder to do. And it's not for everybody. Not everybody can build organic relationships with each other. And therefore, yeah, I do think then the retail investment world will always have clients, right?
Right.
But What I'm saying is, look, there's another way to do it. You just have to educate yourself. You just have to get that minimum effective dose to educating yourself just a little bit and putting some work and effort behind it. And it's not that hard, but it is simple passive cash flow once you get to a certain point. And then you kind of look behind and you've kind of vastly accelerated your path to financial freedom. It's not for everybody. And I'm thankful it's not for everybody, because if everybody did what I said and, buy a handful of rental properties or, go into a handful of syndication deals, which is probably even easier as a passive investor, and, implement some of these tax strategies and deal with infinite banking. I mean, who would play doctor for us? Who would build our bridges? Who would push the paper, out there? Like society would crumble, right? Like the society needs people to just barely grow their net worth so that they keep freaking working and they pay a lot of taxes in the meantime. Now, I'm not a government conspiracist, but it just happens to be like that's the way to have things keep working, or people work and produce from a GDP perspective. But these days I have the free time to kind of think about this type of stuff. But for whatever it is, like, look, if you're out there and you're investing in the mainstream investment stuff, just consider this alternative path. If you're okay with, working for another 30, 40 years, paying a lot of taxes and just doing the status quo, then cool. But if you're not, do something about it, right? Before you go home, don't just watch YouTube and play on the internet for the rest of the night. Spend listen to the podcast, download my analyzer, do something and just get learning. And then after a while, like this stuff will sink in. You'll be like, oh, wow, this stuff really does work.
And you're right. A lot of things, we're actually closing out the show very soon. I'll close with this, and I found the best reactions of people is when they see progress or they see the results. But the sad part about it is they want instant results instead of waiting a month or 2 months for the money to actually come into them. But they want it like right now. And for that, which is a wonderful time for, what if the people that are listening to this on any platform out there want to learn about your way of doing this, Lane? How can they get in contact with you? How can they learn these ways and actually take that initial step?
Yeah, they can reach out, check out our podcast, Passive Real Estate Investing via Simple Passive Cash Flow is the podcast. We've got YouTube channels, but they can pretty much go to simplepassivecashflow.com, and then you can join our club at simplepassivecashflow.com/club, get access to a lot of our e-courses. But I think we're going to set something up for your listeners where they can get access to maybe the free remote investor e-course in case they want to buy a rental property remotely. That's always a first place to start, especially for the non-accredited investors. But yeah, I mean, maybe, just, check us out. We've got a lot of free content. I mean, something that I was really against, there's a lot of like shysters and gurus in the real estate world that, teach people mainly how to wholesale houses and do all this active flipping stuff, because they target people who don't have very much money and they charge them like 30 grand, 50 grand. I was really against all that. So a lot of the stuff that I have is free on the internet for people just to consume. It's going to take you time to go through it, right? But,
Right.
you don't pay, you got to pay with something.
Yeah, everybody pays with something, whether it's time, money, or bartering for something. But Lane, I appreciate that. Listeners, keep tuning in. Check out the Facebook group, Making More Money for You. I'll keep posting updates on this. But Lane, I have to cut this out. We're at the end of the show. I wish to thank you for your time, because this content will actually help a lot of people out there to figure out that this is actually for them and they can take the initial steps.
Yeah. Thanks for having me.
Oh,
everybody.
Absolutely. All right, everybody. I'm going to wrap the show up here. Next week, I have Tommy Breedlove, author of Legendary, and he's a motivational speaker. And we are actually going to go from there. See what Tommy will bring for us. I appreciate it. Have a great day.
All clear. Great job today, everyone.